I'ma break the law, then I'ma break the...
I hope everyone's doing well. Welcome back to another lesson. So, today's lesson is going to be on macroeconomics and something called CoT data. We're also going to be discussing news because, of course, that falls under the economics aspect. And we'll be going over how we can trade news and, the do's and don'ts of trading around news. So, let's get into it. So, let's start off by talking about, macroeconomics as a whole, the economy, and the things that affect our trading. So what is macroeconomics, right? Macroeconomics is showing whether the economy is declining or growing, right? And this is done through different models of data. And the main key thing that we want to look for, as you guys should know from the very start that we mentioned, is the interest rates. That is very, very important to the economy. Now, at the bottom, the last point here, I've listed the Monetary Policy Committee, which is the central bank, right? So for America, this is the Fed, the Federal Reserve, and it's their job to set the interest rates for the country. Now, in the economy, right, how do all these things work together? How do things come together? So the first thing to understand is we have different types of environments in the economy, right? We have something called a risk on environment and something called a risk off environment. A good example of this, right, is if you guys go look at the DXY chart while Bitcoin was having its last bull run versus looking at the DXY chart since Bitcoin topped out and has been declining. What you should see is that they're very different. Apply the same to S&P, right? Now, what's common between those two? S&P and Bitcoin are both assets. They trade, opposite. They have inverse correlation to the DXY, the dollar index, right? So understanding what sort of environment we're in is going to help you trading because that's a staple. That's a very, high time frame thing to consider. Now, the dollar has been in a bull run, right? The dollar itself has been in a bull run for the previous how many ever months, and crypto has been declining over a year now, right? So if you knew that, you would not have been short on the dollar on the higher time frame. And if you're not short on the higher time frame, that will also translate down to your lower time frame buy. So you would have been on side most of the year, right? Cool. Now, I'm assuming a lot of you have heard of the term inflation, right? But you may not know what inflation actually is. Inflation, right, is essentially, are things getting more expensive or are they getting cheaper every month, right? And what it is with inflation, they want to keep it at a certain level. So with the Fed, their target for inflation is around 2%. Right now, inflation is a lot higher than that, right? Inflation's somewhere, I believe, around the 7-8% mark for them. And so clearly, because it's so high, they want to bring it down. So they have a mechanism for this, right? This mechanism is called quantitative tightening. When inflation is, low and they want to, increase spending in the economy, they want to help the economy grow, they will do something called quantitative easing. So at the bottom, I have a chart for what quantitative easing actually is, and we're going to, talk about that. So in this, little graph here, this is the Federal Reserve, right? This is US dollars, which, we can say the Fed own, right? They're in charge of the US dollar. They're giving the US dollar to these banks, right? In turn for these bonds and equities. So essentially, they're buying these bonds and equities off these banks. If these banks have more money, the money can go to the people. So, as it says at the bottom, it occurs when the Fed buys long-term securities to boost the economy, which is here, bonds and equities. It increases the money supply and lowers long-term interest rates. It makes it easier for banks to lend and people to borrow, right? So let's break that down. The Fed owns the dollar, right? They control how much of the dollar we have, how much is being printed, how much is in the supply. So let's break that down further. So it comes down to supply and demand, right? If there is a lot of dollar in the market, right, a very large amount of the actual currency, there's a lot of supply, and therefore, there will be a decrease in demand. and vice versa. So quantitative easing is used, right, to help the economy grow by pumping more dollars into the market. So when there's more dollars, what happens? When there's more dollars, these banks over here, they will have lower interest rates, as will the Fed, right? Interest rates will drop. And because they have lower interest rates, what's happening is that it's cheaper to borrow money. So what does this do? It incentivizes people to go get loans, businesses to get loans, borrow money, invest into businesses, buy things, that is essentially what gets the economy going. If everybody's spending, there's a lot of money flowing, everywhere, then the economy is growing. Now, when inflation is really high, what's happening is, right, that what you're earning is essentially dropping against how expensive everything's getting. So if inflation is now sitting at 7%, right, or 8%, let's say, and you earn 20k and your pay does not go up by 8% in line with inflation, then essentially you've lost money, right? And what's going to happen in that process is that things will get more expensive, as we're experiencing right now. I'm assuming most of you guys are from the UK. You should be experiencing, you're seeing everything get more expensive. That is inflation in play. So now if your pay, your salary, your wages aren't going up, then essentially you're at a loss. And this situation will get worse and worse and worse, and it'll get harder for people if, the inflation doesn't come down. Now, when I said that, you guys probably imagine, day-to-day things. Let's say the price of a meal dough gone up to £3.90. It used to be £3 not too long ago, right? But you also have to think on a bigger scale. Think about mortgages, big business loans. If the interest rates are very high, nobody's taking them out, right? And then that also has knock-on effects, domino effects. Nobody's buying houses now. There's a lot of houses on the market. There's a supply. There's not enough demand for it, based on the fact that people can't borrow money. It's too expensive. So all these little things, they have a knock-on effect. And the job of the central bank is to sort of find that balance before we have a crash one way or the other, right? Now, quantitative tightening, which is, essentially what heading towards that, or doing something called tapering, which is, reducing or trying to reduce inflation. What's happening in that process is now we're hiking the interest rates, right? And we're reducing the supply of the dollar in the economy. And what's going to happen now is if we're reducing that supply, the price of the dollar is increasing, right? It's basic supply and demand. So the value of the DXY, the dollar currency index, has been increasing, right? And that's ever since the Fed started hiking interest rates. Why? Because when they're hiking interest rates, less people are incentivized to borrow because it's more expensive. Therefore, there are less dollars flowing in the economy. Now, as I've said, I already discussed it, but essentially, there's a real life impact, which is things getting more expensive, and then it, has that domino effect that I was talking about, and then the impact on the actual currency / the charts, which we're seeing on the DXY and being reflected on the other currency pairs like Euro, USD, GBP, whatever. Now, the interesting bit, the news events that, you guys probably want to hear about. The FOMC is the Federal Open Members Committee, right? And they're responsible for setting the interest rates. Now, this news event in particular, right? Very big news event. The markets slow down. There's, you can tell the markets are coiling up, ready for FOMC every time it happens. Now, why is this? Back to the very basics. What is the most important thing that I mentioned to you guys? What is the driver for the forex markets? It's the interest rates. So if the interest rates are being decided, it sets a precedent until the next meeting, right? And these interest rates are decided based on the other data they received during the month, such as NFP or the CPI. And therefore, this is their reaction saying, oh, inflation was too high, unemployment was too high, therefore we have to, blah, 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 right? So it's a reaction to what the data that they've just received. Now, FOMC in specific is at 7 p.m. on the days that it happens, and it is a news event that I would not recommend anyone to trade. On that particular day, I don't really look to trade sometimes in the morning, for the London Open session, but past that, not really. Now, they set the interest rates, they have something called hikes. You guys have probably seen, it will say something like 25 BPS, 50 BPS, 75, whatever. BPS stands for basis points and is actually a percentage. So 25 BPS is a 0.25% increase, right? And 50 BPS 0.5%, so forth. The NFP and the unemployment data. So NFP stands for non-farm payroll, right? And what the unemployment data is basically showing is how many people are economically active. They're still spending and stuff, but they're not in a job. This data does not include disabled people. It just includes people who are economically active, and as I said, they're not spending, right? The NFP measures the change in employment numbers, right? And it's done once a month, right? It's on the first Friday of every month, yeah. And you'll see this data come out. NFP again is another news event that I would not recommend trading, right? It's part of the narrative, something that has a big focus currently in the economy, and therefore there's a very, very big move on the DXY generally every single time it happens. And it's a very manipulative move, so that is why I don't recommend trading it. CPI I've been talking about, this whole time. The Consumer Price Index is what it stands for, and it's determining inflation month to month, right? It's deciding how expensive or how cheap things are getting month by month. So what the CPI actually is a survey sent out to households to see how much they spend on goods and general services. And the way CPI really changes, right? And as I mentioned before, companies make things more expensive. For example, Tesco, right? They have something called a cost of production, right? And a big driver of the inflation is an increase in energy and oil prices. So when this increase happens and these companies feel it, what do? They pass down that cost to us, the consumers. And that is how, things start getting expensive in that retail sense. The last one is something called GDP, right? Which is the gross domestic product. That is, essentially everything put together in the economy in a given time period. And they're saying, the services and the goods that were made in that economy is essentially the big figure. So that, what it shows is economic performance. If that number is declining, right, the economy isn't producing as much, of course, it's not doing as well. Versus if it's getting higher, then of course the economy is growing. One thing to note, as I mentioned before, is that the FOMC, right, the Monetary Policy Committee, is more important than all these other news events, and this is also evident on the charts. Now, the next thing I'd like to speak about. Now, this is something interesting. It's a very new concept to all of you, and it's something you can, directly implement into your trading. I'm going to talk about something called the commitment of traders, right? It's called the CoT report. That's what it is. The Commitment of Traders report is a weekly publication that shows the aggregate holdings of different participants in the US futures market. They're compiled and published by the CFTC in the US CoT reports. And they essentially show you how many people are, long, short, and whatever in the market. And the open interest, which I'll tell you guys, is essentially how many open orders are within the market at that given time. So with the CoT data, right, this is why it's so important. We always discuss smart money. We say smart money this, smart money that. The CoT data literally lets you see what smart money are doing in the market. Now, what's important is, smart money essentially trade on the higher time frames as well. But this makes it visible. Understanding which way smart money are, trading the market, getting in line with them, that's what's important. So let's open the charts and I can show you guys. We start off by coming to this website called barchart.com. We want to head over to futures and go to commitment of traders. Cool. Once this loads, you should have to scroll down. You can see the US dollar index, right? And you can see the indexes for the other currencies as well. There's a small description about open interest and how, the CoT works if you want to read more into this. But we'll start off by heading into the US dollar index. Once this opens, right, if you come down here, as you guys can see, it tells you what each line represents. So blue is essentially retail. The green line is, hedge funds, pension funds, like these are like banks, right? But the red, that is smart money. That is, the big players in the market at the moment. So cool. What we want to do is come up here, go to the CoT chart. Go up to settings, close to close, apply. we want to do is get rid of this bottom one and yeah, keep the top one. So cool. Now, as you guys can see, right, we have the chart of the DXY. This chart should look pretty familiar, right? And down here we have smart money. So smart money are represented by this red line. So what have they been doing? So what I want you guys to, remember, recall, is smart money have a lot of money. Like they have very, very deep pockets, right? And when they want to get into the market, as you guys will remember from the IPTA lesson, they can't just get into the market. They can't market execute like us and, just buy it in. They have so much money, you have to essentially split their positions. They have to pair their positions with liquidity. So I want you guys to note on the DXY, right? When we had this big retracement, what are the things to look for? So 1, 2, 3, and 4, right? 4 different lows. From when we had this reversal, right? From roughly here, let's say, where I've lined it up, all we've seen is them add to their long positions. So while the DXY was going down, they were adding to their longs. They were pairing their buys with 1, 2, 3, even 5, 5 large high time frame areas of sell stops, and of course, even on the lower time frame, you'll find more. So during this whole process of DXY coming down, they were pairing, right, their buys with all these sell stops. So now, of course, they're heading towards being net long. As you guys can see, they're not net long. So in terms of seeing net and short long, right, or the overall short or long, what you can do is come down here, place that. Okay, cool. We can change this to 0. Now you can see there's that grey line at 0, right? And once it crosses this, we'll know that they are net long. But at the moment, they are heading towards being net long. That is what we like to see. We're bullish on the DXY, and we can see this is starting to head up. Right? And they've paired all of their longs with all of these short positions. So now we can be confident in our bias to see that, we want to say that the DXY is going to be heading up. Now, as a small practice, I want you guys to do this. I want you to understand how this works. Now, this is a DXY. What you can also do is search the Euro USD, or the GBP or Bitcoin, or the bonds. Find everything on here, right? Anything that's traded via futures. And what we want to do is essentially see where smart money are going. So I want you guys to go and have a look. Now, what I just explained in terms of DXY, as the DXY is going down, what was smart money doing here? You can spot the opposite pattern here, right? As Euro USD was taking out buy stops, they were getting short. They were using all this liquidity to enter the market. Therefore, I would like to be short on the Euro USD as well. That is how we can read the CoT data. We have to understand what smart money are doing. I've already taught you guys how smart money enter the market, how they participate. Now we can actually apply that logic by knowing what they are literally doing, right? And this helps you get that higher time frame bias. Understand when, once you pair these reversals with the news, the time of year, month, whatever, and you bring this in, it's an extra confluence to your trading, right? But that is the CoT data. And I'd like you guys to use this, and we'll be revisiting it in the weekly outlooks from time to time, especially now that I've taught it. Last thing that I'd like to touch on, right, and I've got lots of questions about this, I still do, is trading the news, right? So cool. Most news, when it drops, a very frequent time to see news drop is 1:30, right? 1:30 in the UK, which is 8:30 in the US, 8:30 a.m., right? That is when we get a lot of news drops. Of course, FOMC in specific is at 7 p.m. When these news drops happen, sometimes we see consolidation beforehand. We expect to see, sort of PO3 play. Most news events deliver some sort of PO3. There'll be some sort of accumulation, right? Sometimes the accumulation isn't obvious. Sometimes it's liquidity engineered via a trend line. It's not always, a sideways movement. We get manipulation, then we get distribution, right? And you have to understand which one price will do. Is it going to manipulate? Is it going to distribute? Well, that depends on after the accumulation. Did we have a manipulation? If no, then, likely that the news will do it. Then we also have to consider sessions when news is lined up. Sometimes we get news at 2:45 in the UK. which is 9:45 in NY. That is just before London close kill zone. So when that sort of news happens, and I know that we can trade this specific news, something, for example, flash services, PMI, I know that that news drops at 2:45, therefore London close kill zone will most likely offer a move. You have to frame it together, right? Now, my advice to you guys is first consider your PD array matrix, have your high time frame bias in line, all of these things. Understand that the news will propel price towards what it was already going to do. It's just going to move faster, essentially, right? Faster through time. So the reason I've written out arrays is you want to consider where were your targets for price. Have those targets marked out still and understand, where do I want to see price trade to. I would not recommend trading news ever. I don't recommend trading the news drop, right? Either, right, you're in a position from before, or you will let the news pass, you will give it at least 30 minutes, if not longer, and then you will look to get in line. The reason I say 30 minutes is because we want to see that hourly candle close. And the reason I've said the daily candle is because you want to understand where the daily candle is going. Make sure you have your New York midnight price marked out and you understand, which direction you expected price to head in anyways. Now, when that candle closes, usually that candle will have some sort of large wick, some sort of manipulation that occurred. Seeing the movement of the following candle should allow you to, now start to build a bias again. Sometimes it can be confusing. That is why I've written sitting out. You do not need to trade the news, right? Observe it. If you're listening to this and you've never traded news, this is what I'd recommend to you, right? Wait for the next news drop. Paper trade it, right? Have a position from, so I'm not saying trade the news drop because we don't do that. We don't trade the news drop at all. So the thing that I'm saying to paper trade is let the news play out, let it clear up a bit, give it 30, 45 minutes, and then see if you can spot a sell up to get in line. The manipulation's already occurred now. See if you can get in line with the distribution. That is what we're trying to trade, right? If you're still not confident, just sit out. There's plenty of trading times with or without news. But it's very important you understand what the news does, even if you don't trade it. You know how in the previous weekly outlook, the one that just dropped a couple of days ago, or yesterday I think, understanding how we can frame the news in terms of weekly profiling, understanding that it can, place the highs and lows of days. You have to be aware of these things, right, to not get caught offside. Overall, the news events I mentioned earlier, I would not trade any of those, even being in positions from before, after. I would just, let it rest. You don't have to trade every single day. There's so many trading opportunities. I don't think it's necessary at all. This is in terms of FOMC, NFP, CPI, GDP. Right? Even some unemployment claims data, I'm very careful. You just let it drop, especially with the recent one that we saw, where there was a very big difference in what was expected and the actual result, and therefore, DXY had a very, very rash move. So you have to be careful. The reason, I've taught you guys about news is about understanding the calendar. Of course, I haven't discussed every single news event on the calendar possible. There's still other news events, things such as PPI and other events. You can go research those events. The reason I haven't discussed them today in specific is because they're not as, detrimental to the price action. And you can see this on the charts. It's very evident on the charts. They're not delivering moves as big as NFP, as CPI, as FOMC. FOMC usually delivers the largest move, right? And in an upcoming weekly outlook, I will be talking about FOMC in specific, before the next meeting, and how it actually plays out, because it's quite interesting. But that is it for today's lesson. I hope you guys learned a lot. Here's all my socials as usual. Any questions, anything I can help with, please let me know. When I drop this lesson, I'm going to be attaching a playlist you guys can watch. I have sent this in before, but we'll send it in again, a playlist on YouTube you can watch to better understand economics in general, the macroeconomics, and how money printing, how the current currency we use, right, and money in general, how it all works, right. There's a very interesting playlist called Hidden Secrets of Money by Mike Maloney, and of course I'll link it below so you guys can have a look. But that is it for today's lesson.